So, when you hear the word accounting, what pops into your head? A bunch of boring numbers on a spreadsheet, right? Well, what if I told you it's actually a story? It's the language every single business uses to talk about its past, its present, and where it's headed. And today, we're going to learn how to speak it. To do that, we're going to need a guide, someone who's made it her whole career to translate this language for the rest of us. So, let's meet her. This is Shania Wilson. Growing up, she loved math. But it wasn't until an intro to accounting class that something just clicked. She realized it wasn't just about crunching numbers. It was about solving the real-world puzzles that businesses deal with every single day. So after a stint at a major firm, she went out on her own and started Full of Financial to do just that. She actually calls herself the People's CPA. And look, that's not just some catchy marketing slogan, it's her entire mission. She's not focused on the giant multinational corporations. Her passion is making this financial know-how accessible to the small and medium-sized businesses that, really are the backbone of the whole economy. Because for the businesses Shanae works with, this isn't some theoretical exercise you do for a class. Understanding things like cash flow or what your profit margins really are, that's the key. That's the difference between just surviving and actually growing. So how does Shania empower all these businesses? Well, she teaches them the language of business itself. Accounting. But what even is it really? Okay, I know, the textbook definition sounds a little dry, but let's focus on two really important words here: interpreting and making good decisions. The best way to think about accounting is that it's a translator. It takes all the messy, raw data of a company's day-to-day, and it translates it into a standard format that you can actually use to make smart choices. And this diagram here shows it perfectly. See, on the left, you've got the inputs. All that raw data, sales slips, payroll records, you name it. Then the accounting system does its thing. It processes it all. And out the other side, on the right, you get these clean, organized, and incredibly useful financial statements. So who's actually reading these things? Well, pretty much everybody. The government, like the IRS, obviously wants to see them to make sure you're paying your taxes. Investors need them to decide if they're going to give you any money. But maybe most importantly, the people inside the company, the managers, the owners, they need this information to steer the ship. All right, let's dive into the first of the three big reports, the balance sheet. The best way to think about this one is like a photograph. It's not a movie showing what happened over time. It's a single snapshot of a company's financial health on one specific day. And at the very heart of that snapshot is this simple, elegant formula. Just think of it like this. Everything the company owns, its assets, had to come from somewhere, right? It was either borrowed from someone else, which are the liabilities, or it was put in by the owners, which is the owner's equity. That's it. That's why the two sides always have to balance. Now, a real balance sheet can look kind of intimidating, but don't let all the lines fool you. Every single number on this page fits neatly into that simple equation we just talked about. You can see all the assets listed up top, and on the bottom half, you've got the liabilities and the owner's equity. And if you go all the way down to the final totals, look at that. They match perfectly. That's the balance. Okay, so if the balance sheet was a photograph, then our next two statements, well, these are the movie. They show you what actually happened over a period of time, like a month or a quarter or a whole year. First up, we've got the income statement. This is the one that gets all the headlines. It's pretty straightforward. It starts with all the money you brought in, your revenue, at the top. Then it subtracts all your costs and expenses. And what you're left with at the very end is the famous bottom line, your net income, your profit. This statement answers the big question. Did we actually make money? But you know what? Profit isn't the whole story, not even close. For day-to-day survival, the statement of cash flows might be even more important. This one tracks the actual physical cash. Where did it come from? Where did it go? This tells you if a company has enough cold, hard cash to pay its bills and stay in business. And this is such a critical point. You have to get this. Imagine you make a huge sale, $1 million, all on credit. On paper, on your income statement, you look incredibly profitable. But if your customers haven't paid you yet, you have zero cash from that sale to pay your own employees. This is why people in business have a saying, profit is an opinion, but cash is a fact, and cash is king. So having these statements is great, but their real power, their magic, comes when you start using them to ask questions. And that's where financial ratios come in. They're basically simple calculations that help us analyze a company's health. So let's start with a really common one, the current ratio. This is a quick test of whether a company can pay its bills that are due soon. It asks, for every dollar of debt you owe in the next year, how many dollars of assets do you have that can be quickly turned into cash? In this case, the answer is 2.08. That means they've got over $2 in assets for every $1 of debt. That's a pretty safe spot to be in. Okay, next question. How much is this company relying on borrowed money to operate? That's what the debt-to-owner's equity ratio tells us. A ratio of 288% means that for every single dollar the owners have invested, the company has borrowed almost $3. Now that tells us the company is financed heavily by debt, which, can be a little risky. And finally, let's look at a profitability ratio called return on sales. This tells you how efficient a company is at turning its sales into actual profit. A ratio of 7% means that for every dollar that comes in the door from a sale, the company gets to keep 7 cents as profit. Now, is that good? Well, it depends. You'd have to compare it to how they did last year or to how their competitors are doing. And this is what brings us all the way back around. These ratios, these simple calculations, they're the tools that the people's CPA, Shania Wilson, uses to read the language of business. They help her diagnose what's going right, what's going wrong, and how to guide her clients toward a healthier, more profitable future. So now you have the basic vocabulary. You can start to understand this language. So whether you're looking at your own small business, your personal finances, or even a company you're thinking of investing in, I want you to ask yourself this: what story are the numbers telling you?